Jason, you say the IPO market is really hot right now. There's some kind of bifurcation happening between the names like Uber and Lyft and then some of these other names, Zoom, Pinterest, others that have done quite well. So what's the difference?
So that's clear. There's definitely been a differentiation between some of the biggest name IPOs versus the rest of the market. If we go from the Lyft IPO onwards and exclude Uber, the average first-day return for IPOs is actually 30%, and on average, they've continued to trade higher in the secondary market from that first-day close. So once we kind of strip away some of the biggest names, the IPO market is actually all showing signs of actually being quite hot. I think some of the difference between it is, certainly with Lyft and Uber, very high profile. There was concerns about the valuations and the profitability of these companies. I think that's going to manifest in some uncertainty of how the markets needs to value it. But for the other companies that didn't maybe get quite the hype leading into the IPOs, I think it's helped them sort of perform both in the aftermarket and subsequent, to the IPO.
So, Mike, what's the lessons? The IPO window still wide open? Tread cautiously or no?
I think it's definitely wide open in the sense that portfolio managers, investors are craving new names that are not in their benchmark, that show like they have some kind of unique business profile or capture some trend. Beyond Meat seems, if anything, almost an old-fashioned zeitgeist IPO. In other words, in any IPO market, you can kind of catch lightning in the bottle with a product that has this kind of public appeal. It seems on the upswing. That isn't representative of much to me. The rest, though, of the general tech IPOs outside of Uber and Lyft are, we have a software-based platform-type company. It's a hot area of the economy, the market, and we're looking to raise capital for, and we're going to take care of that capital well. That's the thing that Uber and Lyft have not really persuaded investors about, that the capital you're putting in today is actually going to generate a return, and we can see the end. We can see the number down the road of users, of rides, of whatever it is, where it properly scales, and we can make a return on that capital.
Hey, Jason, you say that by the fourth quarter, current IPO firms will have to start showing a path, at least, to rapid sales growth. What's magic about Q4?
So by that point in time, some of the companies that are going public in this quarter, they'll have reported at least probably 2 quarters of earnings. So at that point in time, they need to start to demonstrate that the business models that they have can actually start to generate earnings, not just higher revenue. If we look historically and we go back to the dot-com bubble era of the late 1990s, it was oftentimes about 3 or 4 quarters after the companies went public that at that point in time, investors needed to see proof that the valuations that they're pricing these companies need to be justified. So I think you get a kind of a window of 2 to 3 quarters before you start to need to show that this is going to materialize. On top of that, by the fourth quarter, the lockup expirations for these companies expire. This is usually 6 months where the pre-IPO shareholders agree not to sell their shares. Once they expire, then you can get certainly venture capitalists starting to sell shares. So between sort of the expectations for earnings, but also for companies, you're going to see more supply on the market in terms of existing shareholders. That all else equal puts downward pressure on the stock price. So that creates an environment where companies have to start to demonstrate their ability to generate earnings. Otherwise, their stock prices could come under further pressure.
Jason, in terms of what is in the pipeline for more IPOs this year, what are you most excited about?
Well, certainly some of the bigger names, whether it's Airbnb, WeWork, they're going to attract a lot of attention. I think what we've seen thus far this year is definitely differentiation in performance. And so given the performance for Uber, of Lyft, where I think investors are really going to scrutinize is understanding what's the business model, what's the revenue model. So companies that are maybe more software or services oriented, that investors can sort of value, they understand where the revenue stream is going to come from. I think it's one of the reasons why Zoom has done very well versus Uber, where I think there's still some questions. So it's going to be, I think, more of a differentiation going forward, where companies are really or investors are going to crowd into those stocks that look like there's a clear business model they like. Others, there might be a little bit more difficulty in terms of the offer price or the ultimate performance in the aftermarket.
Mike, how big a role are short sellers playing in this post-IPO action compared to historical? I mean, the Beyond Meat stat is interesting, but I wonder.
Well, Beyond Meat, because of course it had done so well with huge sustained pop, a very low float, I do think that short sellers are a bigger factor there because they're trying to crowd in and bet against this huge parabolic move. In general, I don't know that it's necessarily a theme that runs across IPOs. I know Leslie has been reporting today that actually the short intensity in Uber has been very light relative to some others because there's $8 billion worth of stock out there, and it didn't do well from its first print. So I think that there's not necessarily short sellers in control of this market. It seems to me there were two reasons you might have used this little IPO boomlet as a test of maybe there's something to worry about. One would be every single deal goes to the moon. It shows a lot of exuberance. It shows a lot of heedless risk-taking by investors, a lot of speculative action in the market. Not seeing that. The other one could be everyone interprets the IPO boom as smart money selling to dumb money. The private investors got all the upside, and now they're dumping it. And that's not been a consistent conclusion, but I do think it is an overhang on how we interpret what's going on with Uber, because it seemed like it was about the pacing of the private investors' need to get out, and you had a certain number of funding rounds, and it was just time.